Hey, hi. So welcome to the valuation video of Agarwal Industrial. So this is the last video, that is video 3 of this short series. Okay. So in video 1, we looked at the business of Agarwal Industrial. And then in video 2, we assessed the management quality of this business. Now in this video, we would use discounted cash flow methodology, that's DCF, to value this firm, this business. All right. So we'll go full throttle. We'll project out the 3 financial statements and then and project out the future cash flows and discount them to the present to arrive at the fair value of this company. Okay. And but if you are someone who's not really interested in the mechanics of valuation, then I would suggest that you just skip past the next few minutes. In fact, you go to the last 5-10 minutes of this video. Okay. And where I would be concluding my valuation. Okay. But let me tell you, I'm not a SEBI registered analyst. I'm making these videos just to help people, uh, you know, help people learn how to analyze and value a business. All right. Okay. All right. So let's get started. All right. So this company is a micro cap. All right. So if you see, it's 1200 CR worth of micro cap market cap company. The PE is 12. Okay. And the company has actually done quite well recently. The stock price has last 3 years it has become 4x, and interestingly, the famous investor Ashish Kacholia, he took a position in this company in I think in September 2022, around that time frame. Okay, and he's increased his stake, in this company. That was another reason which got me interested in this company. All right. Okay. Now let me open up my spreadsheet. All right, so I've done some work ahead of time. So in this spreadsheet, I have pulled in the last 4 years of their P&L, cash flow, balance sheet. Now also, I have tabs in which we would be taking assumptions along the way. All right. So wherever I have used blue text, that is for that means that's a hard code. That's a pure assumption. All right. Okay. And to the extent possible, I have put in the reasoning behind my assumptions here. Okay. All right. Okay. So let's start. Okay. See, for any uh, discounted cash flow valuation, the first step really is you need to estimate, project out growth. Okay. Then you need to project out profitability. That is, you need to project out cost, which you need to remove from growth to get to profitability. Okay. And then also you need to project out your capital. That is your capex and working capital schedule. All right. So these are like fundamental requirements before you can project out your free cash flows. All right. Okay. So let's start with since this company, it imports bitumen, which is used in road construction. Okay. So the ideal way to project out growth would be to assess, okay, how many kilometers of road would be constructed in India 5 years out, 10 years out. Okay. And what portion of bitumen would be consumed per kilometer of road. That's how you think, and that's what these two parameters you need to project out what is the market potential. And then the second step is what portion of this market would be imported. Okay, what portion of the bitumen requirement would be imported. That's two. And third thing is what portion of the import market would be acquired by this company, Agarwal Industrial. Okay, so that's the way to think about it. All right. Okay. So, but in market potential itself, I struggled because although India, there are articles and there is information out there in which says that India would be building around 2 lakh kilometers of road in the next 10 years or so. Okay, I'm talking about national highways. Okay, so there is runway for growth, but there is not much data regarding state highways. Okay, national highways is just one. Then there are state highways, and then there are non-highways, the usual roads, and then there are gram sadaks. Okay, so not much data about them. Okay, and so 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 instead of breaking my head and trying to get that data, if in case you have the data, please I would really appreciate if you can provide those data points and just perhaps just give me some guidance. All right, so I can make use of them. So in the absence of those data points, what I did is I read through some blogs, some industry articles, also looked at the management commentary. Okay, so what I did. All right, so let me walk you through my assumptions in this whiteboard. Okay, so India ka consumption of bitumen right now in 2024 is 9 million. I'm assuming 5 years out, that is by 2029, the consumption would increase by 2.5 million to 11.5 million. Okay. And if you go back 5 years in time, you would see the bitumen consumption of India has increased every year. And 5 years back, it was over a period of last 5 years, it has increased by roughly the same amount, that is 2.5 million. So I'm roughly in line with history. Okay. The second assumption I've taken is key PSU production. Okay. Right now, PSU production as a portion of 9 million. So PSU supplies around 60%. Okay. I'm assuming for a period of 5 years, the production will will lower slightly to 55%. Okay. So right now, PSU supplies around 5.6 million. 5 साल में, in 5 years, they'll supply around 6.3 million. So absolute basis, it would still continue to increase because PSUs are increasing refining capacity in which ways. So I didn't want to assume that they would not increase their bitumen production at all. They may slightly. Okay, so that's my assumption. All right. Now the gap between consumption and PSU production would have to be met by imports as it is today. So right now, India is importing over 3 million, around 3.4 million bitumen. Okay, all right. In 5 years, okay, so the differential between these two, okay, the gap of around 5.2 million would have to be met by imports. 5 years. So this would be the market ka size 5 saal mein. Okay, all right. Now, if we talk about AICL ka market share right now is around 14% volume basis pe. In volume basis, the market share, I'm assuming it would increase to 20% on the back of, because they are the largest player in India, they have a lot of infrastructure set up. Okay, so I'm assuming they would be able to steadily increase their market share at the expense of some of the smaller players out there in India. Okay, so 20% of this 5.2 million equals close to 1 million or just a little over 1 million. Okay, and right now, what they are saying is 2024 May, they would be closing in at around 0.5 million. Okay, so what I'm assuming is, in fact, in my model, I have it at lower, but any which ways. So basically what I'm assuming is they would double their imports, okay, in 5 years. That's what I'm assuming. Okay, and in fact, they're going to say that they would increase the imports to 1 million sooner, but let's be not as optimistic as they are. All right. Okay. All right. So now we've discussed the growth part. Let's quickly project out the cost line items as well. So first is direct expenses, the cost of goods sold. See, they sell, historically, they have been selling, the realization of bitumen in India is around 40,000 rupees per ton. And as we discussed in the earlier video, PSU is the price setter. Okay. So I'm going to assume that it's going to be 40,000 for the future years. Okay. All right. And the spread, again, the spread, कितने में बेचते हैं and कितने में माल खरीदते हैं, the spread would be the constant. Okay. Right. And any which ways realization doesn't matter. It's the spread that matters. Okay. It's a commodity at the end of the day. And we touched upon this. All right. So I'm going to assume, okay, the realization, the spread would be same as last year, around 2,400 rupees per metric ton. Okay. All right. So the COGS would be around 37,500 rupees. Okay. And then in percentage terms, as a percent of realization, it's around 94%. All right. So let's just link this portion very quickly. Let's put this here. Okay. Total cost of material would be COGS per empty times the total bitumen value, volume. And since everything is in lakh, so I divide by 1 lakh. All right. So this is the total cost of materials. Okay. I realized I did not put in the formula for, we projected out the growth, but we did not put in the formula for revenues. Let's do that very quickly. So bitumen, okay. So we've already projected out the quantity. So the quantity is for 2024 is this much. This times the realization of bitumen per metric ton divided by 10 to the power 5, which is 1 lakh. Okay, let me drag it. So this is the bitumen revenue that they learn. Okay, so bitumen is around 85% of the overall revenue. I've already, in blue, I've already slotted the portion of revenue that they make from vessel logistics, petroleum, road logistics. These are small. Okay, so more or less I've assumed, okay, that future would rhyme with history. Okay, so I've plugged in the percentage already too in the interest of time. All right, and I'm not going to project windmill and some of these other items because they're insignificant. All right, so let me just sum up the overall revenue. So this is the revenue. So we have the overall revenue projected. We have the cost of material projected as well. Okay, now we need the manufacturing, the other direct expenses, and some of the indirect expenses. Okay, so we need these 3 items. Okay, let's go to our assumption sheet. All right, now let's project out the other direct expenses, which are manufacturing, operating, and other direct expenses. So one thing here you got to keep in mind is, see, one thing that they have communicated is, if they service their volumes, service the bitumen import through their own vessels, then it'll be more profitable, okay, than if they use third-party vessels. So what they're trying to say is, abhi they incur a higher direct cost if they take a third-party service. All right. Now, and since we are saying that over a period of time, third-party reliance will go down, reliance on third parties would go down, and they would continuously ship more and more volume through their own vessels. Okay, so the direct costs relating to those third parties should go down as well. So that's why I have this note here. Okay, direct expenses relating third-party vessels will reduce gradually in the out years as this company services more and more volume through its own vessels. Okay, and for this year, FY24, obviously the results are not out yet for FY24. Okay, right? So I've estimated after adjusting for the direct expenses which they'll incur both through their vessels and through their through third-party vessels, I arrived at 9.4% would be, as a percent of revenue, would be their manufacturing, operating, and direct expense. Okay, which is pretty obviously in line with history. So I'm assuming कि future years में slowly वो gradually कम होगा. Okay, so this is what I'm going to assume कि gradually it's going to go down as they service more and more volume through their own vessels. Okay. So since we have the direct expenses percentage now, so let's link it with the P. All right, so I need to pull these. Okay, I need to pull the percentages. So let me go back to the sheet real quick. So the manufacturing and operating direct expense would be this percentage times the total revenue. Okay, and then let me drag this. All right, so we are done with total revenue projection. We are done with the direct expense projection. Okay, so now what's left is we need to model the indirect expenses, that is the employee benefits and the other expenses. All right, so let's do that. Right, so these indirect expenses that we need to model now. All right, so these are small, but now they should reduce over time, because see, they'll have this business will have operating leverage. All right, as they scale. Okay, as they scale, so these indirect expenses or the variable expenses, okay, they should reduce over time. When I say reduce over time, as in on an absolute basis they will increase, but on a percentage basis they should reduce over time. All right, so let's so in if you see in 9 months of 2024, the employee benefits per metric ton was 228 and the other expenses was 514 per metric ton. All right, so these should reduce over time. So let me just make an assumption. Okay, so if you see 2024, we have 228. That's the employee benefit per metric ton, okay, in rupees, and reduces to 220 and then goes all the way to 160. Similarly, other expenses, it also reduces over time. All right, okay. So let's pull this in the P&L as well. So in the P&L, this would be employee benefit per metric ton times the volume that will be imported, divide by 10 to the power 5 because everything is in lakhs. Okay. And similarly, other expenses, same thing. Okay. We pull this by 14. That is the other expenses per metric ton times the bitumen quantity that would be imported. Divide by 10 to the power 5. Again, let's pull this. Okay. And also let's calculate the percentage as well. Okay. So you see, this is reducing over time. It was 0.44 in 2023. In 9 months, it increased slightly to 0.51. But then over a period of time, based upon our assumption, it should reduce. Okay. But on an absolute basis, it is increasing. Okay. And same thing should happen for other expenses as well. It increased to 1.16 in 2024, and part is reducing over time, but on an absolute basis, it is increasing. Right. So this is the power of operating leverage as a business scales. Okay. Now let's just let's quickly calculate the total expenses, which is the sum of both the direct and indirect expenses. All right. So EBITDA would be sales minus all the operating expenses. This is sales minus all the operating expenses. So let me pull that really quick. Okay. So EBITDA, the percentage would be, EBITDA margin would be EBITDA divided by total revenue. Right. Okay. Right. See, one thing. Okay. So you would have expected the margin to increase over time as well, right? But you don't see it being reflected in these EBITDA margin, right? 9.9 in 2024, then drops, and then starts increasing. Why is it so? Because that's a very legitimate question, right? Because see, employee benefits are reducing. Okay. The direct expenses are reducing as well. So both direct and indirect expenses are reducing. Okay. In fact, so I think the answer would lie somewhere here. So let's look at the COGS percentage. Okay. Sorry. Yeah. All right. So you see, okay, you see the COGS as a portion of revenue. Okay. That is not declining. Okay. But all the other expenses as a portion of revenue, they are declining. That explains the reason why the EBITDA margin, okay, the EBITDA margin is not declining, is not increasing as we originally thought. All right. And you may wonder, why is this not, at least it should be constant. It cannot be constant because if you recall, although the spread that we assumed is constant, okay, the spread that we assume is constant, okay, here, all right. So, so the percentage, yahan se jo percentage aa raha hai, okay, that should be constant as well, okay, but the contribution from these revenue items, vessel logistics, petroleum products, road logistics, okay, if you see their portion, their distribution in the entire revenue, okay, that's declining over time, and that's because of my conservative assumption. If I assume that over the next few years, the contribution of these line items would be the same as what it is today, okay, then what would happen is you would see EBITDA margin would also increase over time, okay, but I just wanted to be conservative. All right, okay, because see, think about it, right? Bitumen vessel logistics, right? This is that portion of revenue, which they until now they give their vessels to third parties on rent. Okay? Over time, when they increase the utilization of their own vessels for transportation of bitumen to India, okay, so less and less they would be giving their vessels to third parties, right? Because खुद use करेंगे, they'll use it on their own more and more, and कम देंगे third parties को, right? So that's why, again, this will reduce. That's the reason behind me being, me not assuming कि the portion of this line item, would not be the same as what it is today. All right. Okay. I'll just add that. All right. Okay. Now let's move forward. I think we're done with EBITDA. Finance and DNA. We cannot project finance and DNA right now, okay, because we are yet to model the balance sheet, okay, which we'll do next. All right. So first, let's complete profit before tax. I know we cannot complete it, but still, let's just at least link the model. Okay. Profit before tax, it's EBITDA minus finance minus DNA. tax is 16%. Why not 25%? Because see, their subsidiary, that shipping subsidiary, is in Dubai, which has zero corporate tax. So the effective tax rate is 16%, which is what we're going to assume in the out years as well. Okay. So tax is 16% of profit before tax. All right. OCI is other comprehensive income. We're not going to assume any OCI. It's small any which ways. It's like 5.986 CR. Profit after tax is your profit before tax minus tax, right? Okay. And then percentage profitability. Obviously, the percentage, the PAT and profit before tax, they look inflated right now because we are yet to model finance the interest cost and the DNA and remove them from PBT and PAT. All right. So once you model them, they should become fine on their own. All right. Okay. All right. So now let's move on to the balance sheet. So before we start modeling out the balance sheet, okay, it's important that we analyze the balance sheet as well. Now I will not be doing the analysis in this video. Video would become very big and I would make a separate video on how to analyze the balance sheet. But if you see here, what I have is I have the snapshots of my last 3 year balance sheet analysis in this page, in this tab. Okay. So this is from the balance sheet from 2021, 2022, and this is from 2023. So just, I know this is messy, but just read the headline. That's it. The headlines up top. Just read through it. Okay. यहाँ पे क्या कह रहे हैं? See, balance sheet बताता है, tells you how company is allocating and using capital over time. Okay. All right. So if you read through the first headline, that 40 CR loan plus internal accruals funded capex and their inventory, that is working capital. Okay. Next year, क्या हुआ? They made a lot of profit. So a higher portion of internal accruals, that is retained earnings, plus some borrowings. That means they were able to reduce their borrowings. They paid down their borrowings. So basically 100 CR retained earnings plus some borrowings funded the capex and the working capital. Next, उसके अगले साल क्या हुआ? Combination of internal accruals, okay, and payables, okay, funded the capex. They bought 3 ships and current assets. Okay. So what it tells is, if you combine all these 3 statements together, so what it is telling us is that over time, okay, the company is able to pay down its debt, okay, udhar kam kar pa rahi hai, and it's able to fund the capex and the working capital requirements with their own earnings, internal accruals. So this is quite healthy, to be honest. Okay, so very healthy capital allocation and capital use. All right. Okay. So I know I'm not spending a lot of time here, but it's important that we analyze balance sheet before we can just start modeling out. Otherwise, there is no point modeling if you don't understand it. All right. Okay. All right. And when we model this, we'll also realize that they may want to raise some debt. Okay. And then they'll pay down this debt over time. So that will come across that scenario while we model the balance sheet items. All right. Okay. Now let's start. All right. So they have this PPE. Okay. So PPE, I have capex के लिए, I have this capex and working capital schedule. तो ये यहाँ पे मैंने already I have ahead of time I have put these in. All right, so let's start modeling these balance sheet items. A couple of things to take a note of. So the capex that they've done in 2024 is around 205 CR, okay, which I have here, and plus the capex that they're required to do per ton when they acquire a ship. Okay, so typically if you go back in time, the capex that they're required to do per metric ton, okay, is around 60,000 rupees. All right, okay, that's based upon historical data. All right, so now let's start building these items. Okay, so gross PPE, okay, would be previous year ka PPE plus any capital work in progress, okay, plus capex, any capex that they're doing in the current year. All right, so let's drag this forward. Okay, and then the next item is accumulated depreciation, which I'm showing with the negative sign. Okay, so depreciation we got to project out in the future. Okay, so depreciation kya hoga? Okay, so depreciation is a percentage of gross PPE. Okay, so let's assume, and it was 6% of gross PP last year. Let's assume key future maybe it would be 6%. Very simplistic assumption. Let's track this forward. So depreciation is 6% of gross PPE. Let's drag this forward. Okay. Now I'm just putting a structure. When we put in all the values, so all the slots would be filled on their own. All the cells would be filled on their own. All right. Okay. Now we have the depreciation formula. Okay. So let's estimate the depreciation kitna hoga, accumulate. So take previous year ka depreciation, that's negative. So you add this year ka depreciation. So totally it's around this much. And then just drag this forward. Okay. So net PPE, so our net PPE would be gross PPE plus accumulated depreciation. So it would be this much. So iska bhi formula we have put in. So let's drag this forward. This is done as well. Yeah. All right. Now, the important thing, we also need to project out CapEx. All right. Okay. Because it will keep on getting added to your gross PPE and things. Obviously, everything is linked here. All right. So CapEx को project करने के लिए, if you recall, okay, and pardon me if I didn't cover it, but if you recall, if you saw in this assumption sheet, okay, we've made an assumption regarding the vessels or the tonnage of the vessel they'll buy in the future years. So right now they have this much. Sorry. Right now they have around 100,000 or 1 lakh ton ka vessel capacity, assuming it will remain the same this year. Okay. And in the future year, they'll slowly increase this as we go along. Okay. All right. So this is our assumption. At the same time, there's another assumption that we have taken, okay, is they would also increase the number of voyages as well. Okay. See, if they increase the number of voyages, okay, then they wouldn't have to spend a lot in buying additional ships, right? Because a ship you can use it multiple times in a year, right? Then why there'll be lesser of a need of buying a new ship. Okay. All right. So I'm assuming if you look at my assumption here, assumed average number of voyages gradually increase with increasing capacity utilization. All right. Okay. So what we need to do is, if we go back here, so what we'll do, we'll take this number times 60,000 rupees, 60,000 रुपए per metric ton खर्च करते हैं typically. To take this number times this year ka number minus minus last year's number. All right. Now everything needs to be converted in lakh. So this would be the CapEx. All right. And also, since obviously in 2025 did not add any additional vessel, so the CapEx is 0. But see, obviously they'll incur some CapEx, right? So let's assume at bare minimum, the CapEx that they will incur in any year would be equal to the depreciation that they'll incur in the previous year. Okay. All right. Which is also called as maintenance CapEx, by the way. All right. So let's take the depreciation number from last year. Okay. And then let's add it. D18 needs to be locked, otherwise this formula would go crazy. Right. So this is done as well. Okay. Now, next step, since we have the depreciation, let's link it with the P&L. Okay. Yeah. So let's just link the depreciation. Kahan gaya? I, right? Yeah. So the row should be I. Yeah. This is the depreciation. Let's just drag it forward. Okay. Okay. All right. So this thing is done. The only thing that's left in the P&L is finance cost. That's the interest that we'll do when we come to the liability or the debt side of the balance sheet. Ye bhi ho jayega. All right. Now let's go back to the CapEx. So this is done. I think this is entirely done. So we can go back to the balance sheet. Balance sheet mein bhi link karna hai. All right. Okay. So balance sheet mein, so our PP is done. Okay. Now capital work in progress, we don't need to model out explicitly. Okay. Investment property, I think it's a small item. So let's just keep it. Let's not break our head. Let's just keep it the same throughout. Okay. Right of use asset. Okay. We can model if we want to, but let's just keep our life simple and just assume that it's going to be the same in the out years. Okay. Goodwill. Let's keep it same as well. This investments is a very small number to even spend 10 seconds over it. Okay. Other financial assets. Okay. Let's also keep this. These are the bank deposits. Some bank deposits that they do in some regular course of business that they need to do. And obviously, you need to kind of read about all of these line items. Yeah. In the balance sheet. Okay. And then here also, let's just assume it's the same. See, the main important thing was PPE, which we've already done. Okay. Now, so the non-current assets would be the sum of all. Right. So this non-current asset part is done. Now let's move forward. Let's move to current assets. Okay. So again, let's go back to the CapEx, to the working capital schedule. I have the capex and working capital schedule in the same sheet. Okay. So in the year 2024, let's assume they'll have the same days of outstanding as last year. Okay. And let's assume they'll have the same days outstanding in the future years as well. Let's take that as option. Okay. All right. So inventory कैसे estimate करेंगे इससे? Okay. We take this number, 21 days of sales outstanding, divided by the actual sales. So we go to the P&L. P&L में sales इतना है. Okay. And then, sorry, this should be divided by 365 times this number, the sales. Okay. And then also let's lock 49. Let's drag it forward. Okay. So our inventory is done here. We just need to link it in the balance sheet. Trade receivables. Okay. 47. So let's assume कि out years clip it will be 47 as well. Right. And same, we got to do the same here as well. What we did. Okay. In fact, same formula could be copied here. Let's not waste time. Let me do this really quickly. Let me do this for all. I know you get the drift. Okay. So I completed this for all the line items, both current assets and current liabilities. So one thing that you would notice is the working capital cycle is 43 days. 2023 May, it was 28. It has increased to 43 as per our estimates. Because if you see, in the 6th month of FY24, the period in which they did release the balance sheet, their working capital cycle was close to 46 days. Okay. All right. So our 43 is quite close. And obviously, we'll change it. Whenever they come out with the FY24 results, we'll change it. Okay. If in case it's too, if depending upon whatever that number is, we'll plug that number. All right. Okay. But I think 43 days is quite reasonable based upon the trends that we have seen. All right. Okay. Now, here I also have the working capital. Working capital really is current assets minus current liabilities. Okay. So let me drag this forward. Okay. And I'm happy to share this sheet with you in case if you really want to learn this modeling. If you think I'm going fast, you can pause this video. Okay. And make notes or whatever, and I can definitely forward this sheet if you need it. All right. By the way, I've done detailed modeling. I've created detailed modeling videos for other companies as well. I'm just trying to go fast here. Okay, in this one. All right. So change in working capital is this year ka working capital minus last year ka working capital. So let me drag this forward. This is done. Now let's link everything with the balance sheet. So our inventory is already linked. Okay. We got to link our receivables. Ka formula I think I didn't put here. So let me link the receivables. So that's done as well. Okay. Cash, ये जो 3 item है, ये अभी link करने की जरूरत नहीं है. Let me, ये जो 3 item है, this will come from the cash flow statement. ये कहाँ से आएगा? Cash flow statement से आएगा. Just leave it. Okay. All right. Loans, very small number. All right. Okay. So these 4 items now, okay, I've kind of clubbed them under other current assets. Okay. So I'm just going to pull up the other current assets. Other current assets कहाँ गया? This was this number, right? Okay. Just making sure I pulled it correct. Yes. All right. So my total would be. Okay. So total assets would be current assets plus non-current assets. So it would be this, and obviously this number doesn't have my cash yet because it's going to come from the cash flow statement. All right. Now let's. So the asset side is done. Just pending this cash item. Okay. So let's proceed to the equity and liability side of the balance sheet. Let's modeling the equity out. Okay. So equity कैसे model करेंगे? Take last year का equity plus see profits, whatever profit you generate, they get added to your equity. Okay. So take the profits from from FY24. They will get added to this year ka equity. So this is the profit. Okay. And I also need to see I've added the profit. Okay. I also need to take out dividend. Okay. That we'll do later when we project out dividends. Okay. So let me drag it. Okay. Now let's do the non-current liabilities side. Okay. This borrowing, lease liabilities. Okay. So these 2 items, let's put them in yellow. These items we'll model once we model the cash flow statement. Let's just leave them right now. अभी छूते नहीं इनको. For other financial liabilities, and this would be very interesting, by the way. This would be very interesting. Okay, as to how do we model borrowings. In fact, this I would say would be the highlight in case you would understand how do you model borrowings in the first place, and when does a company need to borrow. The model is going to tell you. Okay. So other financial liabilities छोटा number है, let's not take our head. ये भी छोटा सा number है, तो इसको ना खींच देते हैं. Let's not sweat the small stuff. Okay. So net current liabilities with the exception of borrowings model हो गया है. Okay. All right. Now let's move forward. In fact, ये वाला भी जो borrowing है ना, ये वाला भी borrowing. In fact, you know what? Let me do something here. जो borrowing 2024 में होगा, that would be this borrowing plus lease liability plus this borrowing plus lease liability, because lease liability is a borrowing, is a debt. Okay. This is the outstanding borrowing, but again, this has not been modeled completely. Okay. All right. We'll complete the modeling when we come to the cash flow statement, as I said. All right. Okay. So इसको भी let's not worry. Okay. ये करने की जरूरत नहीं है, not needed, because this is a part of this borrowing. I'm going to club all the borrowings together. Trade payables. All right. The payables, everything we have modeled already. So we just need to payables. We need to just take from our capex and working capital wala schedule. So payables would be it's done. Okay. All right. And now these four, I've clubbed them under other financial liabilities because I didn't want to kind of waste time modeling them separately. Okay. So I've clubbed them together. Okay. So just let me यहाँ से उठा लेता हूँ. Okay. तो ये सबको साथ में ही है item. All right. Okay. So let's do a sum total of my current liabilities. Okay. So my total equities and total liability is this much. All right. And if you see, my balance sheet is not balancing. Obviously, it's not going to balance right now. Okay. So this is this check that I've put in here. This is asset minus liability. So you see my assets are far exceeding my liabilities right now, which is fine. अभी कुछ भी मतलब नहीं है. अभी तो करनी है balance sheet balance. All right. Okay. So the next thing that start modeling the cash flow. Okay. All right. So let's do that. Let's go to the cash flow statement. Then the cash flow statement, first let's pull net income. Net income P&L से आएगा. So let's pull very quickly. Let's pull it. Okay. And what I'm seeing is I have not modeled the finance cost yet. So let's do that. Okay. All right. And then we'll resume the modeling the cash flow statement. See, the finance cost, interest cost is as a percentage of the debt that you have taken. All right. I know we have not fully modeled it, but at least let's put in the formula. Okay. So it was the interest cost was 7.7 of the total debt last year. So let's assume it would be the same in the future years as well. Okay. All right. So the finance cost would be 7.7% of whatever debt outstanding is there in the balance sheet. Okay. And I know at the risk of repeating myself, abhi model karna hai. Abhi I'm just putting the formula. So I don't have to come back to the P&L. Okay. All right. Okay. So now let's go to the cash flow statement. All right. So here, we have put in the net, we have plugged in the net income, we have plugged in depreciation. The only item that we need to plug in cash flow. See, all right. So let me take a step back. All right. See, there are three elements or three sections in a cash flow statement. There is cash flow from operations, there is cash flow from investing, and there is cash flow from financing. Okay. So in the cash flow from operations, you need three things. One is net income. Net income depreciation gets added back because it's a non-cash item. It gets added back. Okay. And then you have something called change in working capital. Okay. In fact, all these things, they are not required. They're just okay. All right. So here, the change in working capital, we've already modeled it. Okay. So we just need to drag it. from the capex and working capital schedule, yahan se ye. Okay, all right. So the cash flow from operations would be sum of all these items. This is the cash flow from operations that they are generating. Next is cash flow from investing. इसमें we just need to model one item which is capex. Okay, capex कितना किया है इन्होंने? Capex इन्होंने. So for that we need to go to the capex and working capital schedule. So यहाँ से let's pick it. Okay. Let's move this forward. So capex B, we are done. Okay, and that's it. We're done with cash from investing. Let's not sweat the small stuff. Just worry about the big items. Our cash flow from investing is done as well. Okay. Now let's come to cash flow from financing. और यहाँ पे we'll model, we'll look at debt as well. Okay. So यहाँ पे first see there are two things: total debt issued and total debt repaid. कितना उधार लिया और कितना वापस चुकाया. So that is what we need to have. So these two items, line items in yellow. Okay. So let's go back to the balance sheet. Okay. All right. In the balance sheet. Okay. So let's do something. So this is the outstanding borrowing, right, as of 2024, which I just picked from 2023. The outstanding borrowing here. Okay. यहाँ पे let's add any additional borrowing that you will do in 2024. Okay. Plus any debt that you will repay in 2024. Okay. That's it. That's what I'm doing. Okay. Outstanding में हमने कितना उधार नया लिया और कितना चुकाया वो ऐड कर दिया. ठीक है, ऐड किया है. Okay. And then just drag it forward. Done. Okay. अभी आते हैं इस पे. We'll come back. All right. So and now let's look at the dividend portion. So dividend. So basically, see, I've linked these two line items. Okay. इसमें अभी we'll put in entries and see कि balance sheet में क्या होता है. We'll do that exercise. All right. Okay. Debt, they paid 300 something dividend. The dividend payout last year was 2.9%. So let's assume कि future years में भी almost इतना ही होगा. 3% चलो लेते हैं. Okay. All right. So dividend payment would be, because of balance sheet में it's a payout, right? It's an outflow. That's why I'm prefixing a negative sign. Times payout is as a percentage of profit after tax. Okay. So you're done and you link this, bring it forward. So total dividend paid हो गया. Okay. All right. The moment you're done, immediately what you need to you need to go to the balance sheet. Okay. Go to equity and यहाँ पे add the dividends, or rather remove the dividends, because negative sign है तो अपने आप remove हो जाएगा. Okay. Because you need to adjust the equity with the dividend payout. Equity should reduce with the dividend payout. All right. Okay. So this is done as well. So cash flow from financing, at least from a modeling perspective, is okay. All right. So total net cash में change कितना आया? तीनों का sum. ठीक है. Cash flow from operations plus cash flow from investing plus financing. तो negative है. So basically what अभी क्या बता रहा है कि around 135 CR cash कम हो गया इस साल. Okay. All right. Now that's fine. Be with me. Now this needs to be linked with balance sheet. Okay. हमने बोला था ना cash. Okay. So यहाँ पे what we'll do is पहले we'll basically look at the cash which was outstanding last year. So sum total of cash and equivalents, bank balances, plus investments, okay, plus this. You see, cash negative हो गया. All right, let's drag this forward. Okay, all right. And I'm seeing, although the cash is negative, which is like nonsensical, it doesn't make sense. Fine, be with me. Okay, but the thing to notice, the balance sheet is balancing. Matlab, all our linkages are just fine. They're working perfectly. We don't have to worry about linkages anymore. Okay. Now we just got to take care of this negative cash. And this is where our debt, our friend, would come into play. Okay. So negative cash nahi hoga. तो इसका मतलब company will have to borrow money, right? 75 CR negative cash हो गया. So that means company के internal accruals not enough for their operation, so they'll borrow money from the bank. Okay, so यहाँ पे, so what we'll do is, since they would be required to borrow in money, okay, so let's go to the cash flow statement. और यहाँ पे let's put की 100 crore they are borrowing. And then let's check the balance sheet. It's positive now. Okay, all right. See, अगर अभी उधार लिया है, okay, so if you see, तो चुकाएंगे भी तो उससे फ्यूचर में, they'll also pay down the debt, right, in the future years. If they don't do that, what would happen is, two things would happen. They'll keep on accumulating a lot of cash, which is good. They'll keep on earning a lot of money, a lot of interest money on that, which we have not modeled, by the way. They'll keep on earning a lot of interest on this cash, okay, which is good. Okay, but at the same time, they'll have an interest outgo, okay, because they'll keep on paying interest on the debt as well, any which ways. Okay, so there'll be a, so what they'll typically, what they'll do is they'll pay down this debt. Okay, so we assume कर लेते हैं कि they'll pay down this debt. Okay, and let's just take a look at the balance sheet. The balance sheet में if you see cash थोड़ा कम आ गया, ठीक है, debt भी थोड़ी has reduced. In fact, there is room to reduce the debt even further. अभी भी 100 crore का debt दिख रहा है. That's fine. We can always play with it, right? We can reduce the debt to zero as well. Okay, all right. Obviously, it's going to have an impact on your free cash flow to equity. That we'll see. Okay. Now, so this is done. Now let's go to the valuation. So यहाँ पे see, in valuing this firm, there's a DCF. May first you need to have an explicit forecast period. Okay, so the explicit forecast period that I'm assuming here in this valuation is only 5 years. Okay, and some of you may be surprised why 5 years, because this is a bet on road construction, and the government is going to spend so much on road construction for 10 years, 15 years, 20 years. Yeah, all that is true. To be very honest, I do not know how to, at least for this business, how to project cash flows beyond 5 years. I do not know. I'll accept it. If you guys have good data points regarding regarding कितना बड़ा market है, and how much bitumen would be required 10 years, 15 years, please let me know. Okay, right? That's one. So one is I struggled. That's why, because of my struggle, I'm limiting myself to 5 years. That's one. The other is that's obviously not a very good reason. Okay. The other is, see, there could be, I do not know what kind of disruptions or adverse event this company may run into in the future. For now, the short term or the medium term, they're pretty good. They're pretty safe for 3, 5 years, 6 years, 7. They're pretty, I don't think there would be any problem. But beyond that, I do not know there would be any restrictions on import. Okay. Or the PSUs would be asked to increase their bitumen production capacity. I do not know any of those scenarios could play out. Okay. And even if I give them a forecast period of 10 years, okay, I did not want to, what would happen if I give them a forecast period of 10 years? I would end up giving them ridiculous growth rates, okay, which I cannot justify. Okay. So again, for the sake of being conservative, I thought, let me restrict myself to 5 years. जहां तक मैं देख पा रहा हूं, जहां तक मुझे कॉन्फिडेंस है, उसके बाद I do not know what's going to happen to this business. If I run across very credible data source, and yeah, that this business actually could do really well over the long term, then yes, I'll give them a higher growth period. Okay. All right. Okay. So for now, I'm just sticking with, all right. So EBIT, let's start building this out. Free cash flow to the firm would be, EBIT कितना है हमारा? Let's go to P&L. P&L में जल्दी जाते हैं और EBITDA में माइनस करते हैं depreciation. So this entire thing is EBIT, and then 1 minus tax rate. So this is net operating profit after tax. Okay. So you start free cash flow to the firm, you start with EBIT 1 minus tax, and then you take out any capex. Yeah. You add back depreciation, again, everything is there in the cash flow. and less change in working capital. It's also there in the cash flow. Basically, I'm just pulling everything from the cash flow statement. Okay. So my free cash flow, in fact, this is not equity, this is free cash flow of the firm, would be sum total of all these items here. All right. Okay. What about terminal year? Because terminal year में क्या होगा? Okay. Let's project the cash flow from the terminal year as well. Okay. तो क्या करेंगे? Here we have the return on invested capital. Okay. So let me, which is net operating profit after tax divided by your equity plus debt minus cash. Okay. So this is what it is. So let me put forward. Terminal year के लिए, so if you see return on invested capital is 18, 19, 20%, even above 20%. Okay. Terminal year में I'm assuming ROIC would come down to 15%. Okay. और reinvestment जो होगा, reinvestment, okay, वो क्या होगा? It would be this growth. Terminal year में I'm assuming the risk-free growth rate divided by ROIC. Okay. So reinvestment, मतलब the amount of cash, what portion of your profits you would put back in the firm to continue growing. That is what reinvestment rate is. So it is 31% in the terminal year. पुराने साल के लिए भी let's just calculate it. देख लेते हैं कि कितना था. Okay. If you saw I was too fast, just pause this video and see. Okay. What did I do? Happy to address any questions. All right. Okay. Now, तो terminal year की cash flow के लिए, what we need to do is we take the profit from last year, throw it with this risk-free rate, okay, and then remove the reinvestment, okay, and the entire thing gets this is our numerator, divided by cost of capital. Not getting into how I derived cost of capital, the video will become too long. Cost of capital minus growth rate. All right. Okay. Now let's take the present value. So present value होगा 1 plus this year's free cash flow divided by 1 plus cost of capital to the power 1. Let's log the cost of capital. Okay. So enterprise value so the fair enterprise value of this business is around 1600 CR. Okay. अभी इससे market value derive कर लेते हैं. Okay, let's compare the actual market value then. So fair enterprise value, okay, minus debt. Debt कितना है? 2024 में plus cash. Cash कितना है? The fair share value is 914 rupees, 914 रुपए. और आज की डेट में it's trading at around 822 rupees. Okay. Any which way, so the fair market value would be divided by earnings, which is this much. Fair PE is around 10-11. Okay. EV by EBITDA, fair EV by EBITDA is, this is the enterprise value divided by EBITDA. EBITDA कितना है? Around 7, 8. All right. Okay. So see, the market cap right now is 1230 CR. Okay. Fair market value इतना है, तो इसका मतलब only is trading at a discount as per the assumption that we have taken. Okay. All right. So it is this number divided by 10% discount में ये कंपनी ट्रेड करे. Okay. तो अगर assume करें कि there is no PE re-rating, okay, it's a commodity business any which case, there is no PE re-rating, केवल compounding gains होते हैं, Okay, and this is the multiple at which this business trades 5 years out. So ये company कितनी बड़ी बन जाएगी? Let's okay, the company would may so this PE times profit after tax after 5 years. Okay, so this company would become a 2700 CR company. मतलब करीब 2.5 गुना बड़ी हो जाएगी ऑलमोस्ट 5 साल में 2.5x ग्रो कर जाएगी. So which is a CAGR of 17%. Just CAGR of 17%, plus you get 2-3% difference, so around 20% return. So again, this is not an investment advice. I just wanted to, I was just curious to see if this is the PE at which, if this indeed is the fair PE, then, and if this is the PE at which it trades 5 years out, then what is the potential return that an investor would expect over a period of 5 years? So this is the CAGR return. Okay, purely compounding, no PE re-rating. Dividends iske upar, so around 2-3%, around 20%. All right, guys. See, hope this helped. Okay, and there is another method. I just use free cash flow to the firm. Okay, which is the cash flows which are available for distribution both to equity and debt holders. Okay, so usually when a firm has debt, okay, then it's said that free cash flow to the firm is a better method of valuation than free cash flow to equity. Okay, क्योंकि अगर आप free cash flow to equity use करोगे, you'll have to project out debt as well, which we had to do. Okay, तो अगर if you don't want to get into that झंझट of that business of projecting out debt, okay, in the future, कि कितना debt लिया, कितना repay किया, then free cash flow to the firm is a better resort. But if you have conviction, okay, कि what could be the debt issuance and repayments, then yes, please do use this method. Because this is for another video, by the way, but this method at times also has its merits over free cash flow to the firm. But let me use this method as well very quickly. Okay. By this method, it seems it's trading at fair value, reasonable value. Okay, so fair PE क्या हो गया आपका? Fair equity value divided by net profit is around 9.610. Okay, all right. See, so the discount, actually, I don't think there is any discount, right? Because yeah, there's no, so basically it's trading at fair value as per this method. So why do you think my larger point is, when we use this FCFF, okay, it seems key 10% discount trade over. When we use FCFE, it seems key there is no discount. The firm is trading at fair value, business trading at fair value. This is because that's why we don't do free cash flow to equity, because you have to project out these debt issuances, which reduce your cash flow. Okay, which reduce your cash flow. All right. और आपको नहीं पता कि how कि what kind of debt repayments they may or may not do. All right. But any which ways, if you want to be like ultra conservative and if you go ahead with this fair value, and if this is indeed is a fair PE, तो क्या हो जाएगा? 5 years out, if this indeed is the fair PE, then this PE times net profit. So the firm would become almost 2x in 5 years, and the return that one could expect is only compounding return, no re-rating. I'm talking about here. Is around 14.5%. Okay. All right. So anyways, guys, I hope this was helpful. Okay? I hope this was helpful. Again, at the risk of repeating myself, I'm not a SEBI registered analyst. Okay. My intention really was to teach as to how do you analyze and value a business. Okay. And yeah, if in case you need this spreadsheet, I will be more than happy to share it. And yeah, please let me know if you have any questions. Okay. All right. I also wanted to add disclosure that I've taken a small tracking position in this company, and I would buy more shares if I get them at my margin of safety. All right. But again, the key monitorables for me in this company would continue to be one, the management actions, which we discussed at length in video 2. And two, second is the other key monitorable for me would be the growth in the bitumen K imports. Okay, because if there is stagnancy, if there is prolonged stagnancy, then I would be forced to take an exit. Okay, and again, and a third, I think, monitorable would be any adverse regulatory impact, or government action. Okay, so yeah, so yeah, I just wanted to add that. And again, at the risk of repeating myself, I'm not a SEBI registered investment advisor. Okay, the purpose of these videos is just to educate as to how to analyze and value a business. All right. And yeah, so if, I don't say that enough. If in case you find this content helpful, please share this with people who you think would benefit, and happy to address any questions. All right. Okay. Thank you.